welcome to February's Asset Intelligence Market Update. January was tough. The MSCI All Country World Index returned -4% as investors repositioned their portfolios for an era of rising interest rates and tighter liquidity. Expectations have certainly shifted a lot in just a few short weeks. Back in September, the market was pricing in a single rate hike from the Fed this year. At the time of recording, at the start of February, the expectation is for around 5. It's the sheer speed of this turnaround which has caused the recent ructions in the market. So why has this happened, and are there any reasons for optimism amid the sea of red? As is the fashion, let's take the first question first. For the best part of 3 decades, investors have believed in the Fed put. This is a notion that the central bank really doesn't like it when the market falls and will step in to try and shore it up when times get tough, whether that be through cutting rates, printing money, or even just uttering some reassuring words. What seems to have spooked markets of late is that the Fed notably chose not to do this when it had the chance, even in the wake of various US indices falling into or around correction territory. In fact, at the latest meeting of its key committee, the Fed went as far as to commit to raising rates in March, providing that conditions are appropriate for doing so. There was also a hint that quantitative tightening is likely to begin earlier than expected too. As the name suggests, this is the opposite of the quantitative easing process. It refers to the bonds which were bought under QE maturing and not being replaced with new stock. And in his verbal remarks after the meeting, Chair Jerome Powell clearly stated that the US economy no longer needs sustained high levels of monetary policy support. So a change in the investment environment is now clearly in the offing, and it's well known that, particularly in recent years, market performance has often been correlated with market liquidity. So what gives us confidence that the show can be kept on the road? Well, we continue to believe that headline inflation rates will naturally begin to drift lower over the course of this year. The base effect mechanism means it's likely that the impact of high energy prices will drop out of the figures in the coming months. The disruption to global supply chains and demand patterns wrought by the pandemic, which has pushed prices for goods and distribution upwards, will come to an end eventually. A development which should be accelerated by the milder nature of the Omicron variant of the virus. Elsewhere, China has shifted back to easing policy, and this could reduce the value of its currency, thereby cutting the cost of imported goods for the rest of the world. We think that these effects, as well as the Fed now looking as if it will act rather swiftly, will serve to limit the overall degree of tightening which is required by the end of the cycle. And that is likely to prove good news for asset prices in general. That's all from me this time round. Thanks for listening, and if you have any questions or comments, let us know. And remember to like, share and subscribe. Until next time.